Good day to all. My name is Chloe, a senior research analyst from iFAST. Latin America has emerged as the top regional market in 2023, delivering returns of 32% in SGD terms. This was led by the robust performance of Brazil, which delivered returns of 31%. If we break down LATAM equities as a region, it includes 5 markets: Brazil, Mexico, Chile, Peru, and Colombia, with Brazil and Mexico taking up about 63% and 28% of the allocation respectively. LATAM was one of the earliest regions to start its rate hike cycle between March 2021 for Brazil and October 2021 for Colombia, with Mexico, Chile, and Peru having hiked between March to October 2021. This is around 1 year earlier compared to the US, where the Fed began its rate hike cycle in March 2022. As a result of tight monetary policy back then, inflation readings in most of these LATAM economies have fallen from their peaks. The region has now gotten an earlier start on easing cycles. In fact, monetary easing has already begun in Brazil, Chile, and Peru, with these countries having cut rates in the third quarter of 2023. More recently, on 19 December 2023, Colombia's central bank has made its first cut in more than 3 years. We expect Mexico to follow suit with the rate cuts in early 2024. Going forward, we think that LATAM's more accommodative monetary policy can ultimately be supportive of investor sentiment, economic growth, and equity markets. Next, nearshoring of supply chains would help to boost LATAM's growth. The nearshoring of supply chains, it actually gained steam on the back of COVID lockdowns, supply chain challenges, and geopolitical uncertainty. China, long considered the factory of the world, is no longer seen as reliable after its zero-COVID policy disrupted operations at factories. Mexico, in particular, is a key beneficiary of nearshoring, given its large and established manufacturing base as well as its strategic location near the US. Moreover, this nearshoring trend is being boosted by other factors such as cheap labor costs and free trade agreements such as the 2020 United States-Mexico-Canada Agreement and policies like the 2022 CHIPS Act, which could actually bring about cooperation with Mexico on the regional semiconductor production. As companies increasingly look to Mexico to actually boost their supply and value chains, it will in turn boost its GDP growth as investment surges, providing new opportunities for companies and investors alike. Moreover, in recent years, the race to develop clean energy production capacity has picked up pace as countries around the world have announced and implemented ambitious carbon reduction targets. LATAM is no stranger to supplying the world with raw materials, and the region plays a crucial role in the global supply chain for critical metals, given that it actually has one of the world's largest reserves. For instance, more than half of the world's identified lithium reserves are found in LATAM, with Bolivia, Argentina, and Chile making up the lithium triangle. Besides lithium, LATAM countries also dominate copper reserves worldwide. The transition to clean energy would spark decades of demand for these metals, with these low-carbon technologies being more metals-intensive and thereby benefiting the LATAM region. Last but not least, looking at valuations, LATAM equities, they look compelling, trading at attractive levels relative to its historical basis. We maintain our fair PE multiple of 13.5 times for the region, and this would translate to an attractive upside potential of 38%. Investors who wish to gain exposure to LATAM equities can consider the iShares Latin America 40 ETF or the Schroders ISF Latin America Fund. To get the full analysis, scan the QR code or click on the link in the description below. Next, Colin will be sharing on the global fixed income outlook and why we like Asian investment grade bonds. Over to you, Colin.
Hi, my name is Colin, Portfolio Manager at iFAST Bond Research Team. And today, I'll be sharing an investment idea from our 2024 Global Fixed Income Outlook. In the face of a more challenging growth landscape, Asia investment-grade market stands resilient. Based on our observation, most issuers remain profitable with positive earnings growth, while leverage ratios such as net gearing have also held steady. And when we look at the changes in credit rating for Asia IG issuers, we also saw a major improvement in upgrade to downgrade ratios, pointing to a healthy credit profile. In 2022, there was roughly less than 1 rating upgrade per downgrade. However, in 2023, we have seen roughly 3 upgrades per downgrade, which was back to pre-COVID levels. On a broader level, we also expect resilient growth from key parts of Asia like South Korea, Taiwan, Singapore and Indonesia, which altogether accounts for a sizable exposure within the Asia IG bond universe. Growth in many of these Asian regions are being supported by a revival in export demands right now. And as shown by the Citi Economic Surprise Index, we also find that the economic data for the APEC region has also been beating consensus estimates. The greater the line rises above zero, the greater economic data exceeds expectations on aggregate. This also tells us that the region is seeing better than expected growth momentum. However, it is crucial to acknowledge that credit spreads for these segments are slightly tight, trading at about 50 basis points below historical average. For investors, this means that the potential upside from spread tightening may be limited. But that said, we think that higher yields from Asian IG bonds can serve as a compensation. At the moment, it offers an attractive yield of around 5.2%, which is near the post-GFC highs. A higher yield can also provide greater buffer for price downside. Asian IG bonds on aggregate can withstand a 130 basis point rise in rates before investors see a loss. This is almost equivalent to 525 basis point rate hike, which is a big margin of safety. Overall, with credit profiles of Asian IG issuers largely stable, economic growth in the region to remain resilient and yields being attractive, remain positive on Asia IG bonds. We believe that an active allocation strategy can enhance return and provide yields above benchmark levels. For investors seeking specific recommendations, we highlight the Manulife Asia Pacific Investment Grade Bond Fund as a primary choice. For investors looking for a local currency exposure, we recommend the Schroder ISF Asian Local Currency Bond Fund. To get the full analysis, scan the QR code or click on the link in the description below. That wraps up for the sharing of this week. Catch us again next week for more investment ideas and updates.